What's going on, guys? Mike here, and welcome back to another video. Today we're talking about Riocan's latest earnings report, and if you haven't already noticed, they increased their annual dividend by 2.8%, bringing their total per share to $1.11. If you're a subscriber, you already know I hold Riocan within my RSP portfolio. But if you're new to the channel, if you're looking to invest into Riocan, I just kind of want to quickly highlight a few key things about Riocan. And one of them being their dividend history. They were actually paying out 12 cents per share monthly, and it drastically dropped down to 8 cents in 2021. So I just want to highlight this because I do feel that this was a smart move for Riocan. It kind of put them in a good position to weather the storm. You know, this allowed them to kind of be ahead of the eight ball, being able to do their debt repayments sooner, and also put more money into their development pipelines. Now, one thing that is very important to recognize is that yes, they lowered it down to 8 cents, but you can see here on this graph is that they've actually continuously been increasing their dividends year after year. So why is this important? Well, again, going back to inflation, I have other REITs that in my portfolio that has paid the same dividend for like the last decade. So when you think of it that way, if I was living off that dividends, my actual dividend is kind of being eroded by inflation. So it's really good to see how this just increased by 2.8%, which might just be slightly under, but it is kind of keeping up or is close to on par with inflation this year. So again, if you're looking for cash flow investments, Riocan is known for their dividend increases, but there is in the past history where they had to drastically drop it due to market conditions. Just kind of furthering on Riocan as a potential new investor, I'm just going to highlight how they are very invested into the central Toronto. You can see how they actually are one of the top REITs that have the most square footage in the Toronto greater area compared to like First Capital, Choice Properties, and Smart Centers. Me personally, I am also an investor of Smart Centers, but Riocan is definitely one of my favorites. Just kind of furthering on their investment portfolio, they are somewhat diversified throughout Canada. Again, most of their assets are in the Toronto greater area, but they do have 4 assets in Vancouver, 15 assets in Calgary, 9 assets in Edmonton, 35 in Ottawa, and 19 in Montreal. So if you're buying into Riocan, you definitely are buying into a REIT that is diversified through Canada. They are only in Canada. They're not international by any means, but they are one of the top real estate REITs within Canada. Now, one of the biggest things that I really like as an investor within Riocan is I love how they're heavily investing into residential. So you'll see here in their development pipelines, they have about 44% going towards residential and 40% into townhouses or condos. So this is again kind of going to reduce some weight on their retail and office sector in their portfolios, which again I think really puts a really good spin on Riocan and positions them well for the future. Looking back in 2019, they did have only 694 properties in their residential portfolio, and now year to date, almost nearing 3,000, coming in at 2,935 properties. Again, this is really awesome. I think that this is a great way to diversify their portfolio, and I think in the future it's going to definitely help with their cash flow. All right, so if you're looking to invest into Riocan, or potentially you already are an investor in Riocan, this is a very important slide. This is kind of how I really weight on how a real estate REIT is performing. So looking at FFO, which is their funds from operation, their payout ratio of their dividend is 62%, which is really low compared to their competitors. I've talked a number of times in my other videos about Smart Centers and how I wouldn't be surprised if they actually had to lower their payout for their dividends just because of how high it's getting. They did actually come out with their earnings report as well, which I will be covering in another video. So if you're interested in real estate investing, definitely smash that subscribe button and subscribe for that future content. But what I really want to highlight here is 62% compared to the other peers. So again, like I had said when we were looking at the dividend history, I do believe that this puts Riocan in a really good position for the future, whether the interest rates remain longer than expected or maybe they will come down. But either way, once the interest rates start coming down, it's going to increase their funds from operation, which is obviously going to impact their payout ratio in a great way, which should hopefully allow them to continue increasing their annual dividends. All right, now to the financial report, which could be somewhat of the boring section of the video. So, just hang tight here. One of the things I really like looking at is the rental revenue of a REIT, because it's always important to recognize whether or not their rental properties or the rental revenue is increasing, because of course we don't want it stagnant, or we don't want it going down, because of course it's going to negatively impact the REIT. So you can see here in 2021, we do have them increasing in 2022 and in 2023. So it isn't a large increase by any means, but it is steadily increasing, which is positive signs for the real estate REIT of Riocan. But again, like I said, I just kind of wanted to highlight that they are continuing to grow, right? So very important to recognize. All right, so just before we kind of wrap things up here, again, this has just been a really quick video, just kind of highlighting the dividend increase. But if you're potentially looking to invest into Riocan, I just wanted to highlight on their tenant mix. So one thing when looking at a REIT, it's very important to kind of see who is in their portfolio, because if they're full of, Cineplexes or places like that aren't necessarily essential services, based on past history with 2020, it's been a thing now, right? We always want to make sure what kind of tenants are in REITs, because if they're non-essentials, we could get into another situation where people stop paying rent because they're forced to be closed, right? So you can see here their grocery and pharmacy and liquor are at the 20 percentile, their essential services being at 16.5, and value retailers being at 12.1%. So just kind of diving into their actual portfolio, their top 30 here, you can see Canadian Tire coming in at 4.4%, which is really good. Canadian Tire, that is an essential company, as well as like Loblaws and Shoppers being at 3.9%. Here's Cineplex that I kind of just quickly mentioned on the previous slide at being at 2.8%. So prior to 2020, they actually had a lot more percentage of Cineplex, but it's definitely drastically dropped. So again, just kind of highlighting on how it's important to make sure what kind of services are in, or what kind of stores are in the REIT portfolio. And one of my favorites here being Walmart. Obviously, it does come in at 2.2%. Dollarama, which is a great company to have, especially going into a potential recession. I'm not sure if we actually are. Maybe it was a soft landing, but again, Dollarama isn't really going anywhere, coming in at 1.8%, and so on and so forth. So again, just kind of highlighting on this, they don't really have any specific company that is like, say, 50% of their portfolio, which is really good. It's kind of no different than diversifying yourself in the stock market. A REIT should always be diversified in what they have as tenants. So I'm definitely curious to hear your guys' opinion on this. Leave a comment below, and I look forward to seeing you next time. Check you later.